All right. Thanks you for joining in. Absolutely. Your interest is very much appreciated. So let's get into it. I have to start off with the usual disclaimer. Everybody's situation is personal and different, so please talk to your own advisors about your specific circumstances and make sure that you seek your own guidance and due diligence. As to what we're going to cover today, we've kept it fairly basic and not simple, basic. The how, the strategy, the with whom, the why, and what's next, because that is where most people get stuck. All right, moving right along, the how. The first question that we ask as property strategists is, are you running a hobby or a business? Because a hobby costs money, and forgive me, I come across sometimes a bit tough, but I want to say it as it is. I want to give you the real tools, the real information for what makes a difference. So hobbies cost money. Businesses should make money. And hobbies are emotional things. Hopefully we're running businesses just on logic and on information. So that's a question that most people, when they really, really dig down, would have to answer that they are running a hobby. Because they do as the Joneses and they needed to buy an investment property. Seemed like a good idea at the time. But doing the homework, getting the research, getting the information, and getting really to become a professional, to do it as a business, is a different story. Unemotional. Well, I think it was, who was it? The big share Mufti, Warren Buffett, that's right. He said you cannot control your money until you can control your emotions. So let's all start off with unemotional research off-site. That's where everybody starts. But please, please, please do it on-site as well. The average house and land package pretty much anywhere around the country is $500,000 to $600,000. What is $1,000? And with $1,000, I can go anywhere in Australia for 2 or 3 days minimum and have a look at the place. It ought to be a system through which we invest. And that is one of the big downfalls of the one-off property investors. They don't have a system they cannot duplicate. And I'll cover it later on as well. The system, in our view, cannot be lose $500 a month in a negative gear to get $150 in tax back. That doesn't make sense when I say it like that, does it? So develop and have a system. I'll cover more on that. Because when you have got a system, you've got a predictable and risk mitigated outcome. It makes sense, doesn't it? Why is McDonald's so successful? Not because they're providing the biggest and best hamburger in the world, but they provide a predictable outcome. You know ahead of time what you're going to get. Now, I'm not going to get into the argument whether you like it or not, but it is a predictable outcome, and that mitigates risk. And risk is one of the biggest things in property investment. From a strategy point of view, have you thought about the difference between yield and growth? Because that sets apart one-time investors and, dare I say, professional investors that do it 2, 3, 4 times. Also from a systems point of view, our system, the Property Friends system, is really geared for a minimum of 3 properties. Because think about it. If you have enough yield, if you have enough rental income, you can continue to buy properties. You don't get stuck on bank lending. Now, if you can continue to go with 2 or 3 properties, you can multiply the capital gains. So the system ought to be a balance of yield and growth. We need what I call the short-term money, which is the rental income, the yield, to cash flow the property. But the big money is the long-term money, is the growth. So a balance between those two is what really works. And you keep going on the funding. So balance between yield and growth. Good. So yield and growth. One investment property just doesn't cut it. If you want to make a real dent into being financially independent, or have choices in retirement, or dinosaurs like me want to leave a legacy, you need to look at 5 or even better 10 property strategy. Now that's not going to happen overnight, that's clear, but it's not the hare that wins the race, it's the turtle. Do it slow, make money risk averse, don't lose it, and you grow your portfolio. That's the way to do it. Risk versus reward. Well, I talked about the turtle and the hare. Yes, there are big rewards potentially out there, but they're usually also big risk. So be the turtle, not the hare. And really, the question is, what's the right deal for you? When I see most of the industry that I'm working in, really, what's the right deal for you? As a property strategist, I don't look at what's on my stock list that is as long as my arm. I look at, where are you at? Where do you want to go? And then only can I develop a strategy for you. Again, that's the difference between the one-off property investor and the long-term multiple property portfolio investor. Looking at what's the right deal for me. And that cannot be, what do I have to sell? It has to be, what is your disposable income? It has to be, what is your time frame? What's your risk profile? They're all things that need to be considered in a long-term strategy. If you just want to go to the pokies and buy an investment property because your neighbor has one, go ahead. Doesn't matter. But that's not going to get you to the result of financial independence, choices in retirement, or leaving a legacy. So a system, long-term, look at risk versus reward, and definitely put it all into context for you specifically. That's what a strategist does. Okay, this has bumped over again. Okay. I talk a lot about strategy and working things out ahead of time. Later on, you'll see we are happy to offer a 30 minutes discovery call. It's a one-on-one, it's free. The link is there. We will also send the link out with a recording. So get the information. What have you got to lose? So I was talking about rental yield and growth. So capital gains versus rental income. I want to spend a bit of time on that. The rental yield is the short-term money. Now, we need to have, in my world, and if you want to do more than one property, high enough income that the property pays for itself. Why is that? Well, for starters, let's take the example of Sydney. 7 years, no growth. Typical rental yield, 3.5%. So you're paying, let's call it $500 to $1,000. Let's call it $500 a month in negative gear, in after-tax money that you pump into the property. for the hope and that you get capital gains, that you get a value increase. Well, for 7 years, that didn't happen in Sydney. Admittingly, the next 3 years, it went up 70%. But how would you like to sit back for a moment? How would you like to spend $500 a month of your after-tax money on a property just to wait for the capital gain? That ain't fun, and it curtails lifestyle. But the big point is, yeah, you may be able to do it once, but can you do it twice? Who has got to 3 properties, $1,500 a month of your after-tax money? Who has got that sort of disposable income to have that going off into long-term capital growth that we are hoping for? Now, the other part of the equation is the funding calculators of the banks. They will stop you dead in your tracks if your portfolio is cash flow negative. Because with every property, you're reducing your borrowing capacity. And very, very quickly, you run out of steam. So the rental yield, the rental income, the short-term money is hugely important if you want to do several properties. Lifestyle, cash flow, I've talked about it. If I've got $500 of my after-tax money going out, that can very severely impact my lifestyle. Maybe you cannot go to the restaurant with your other half 3 times a month anymore. Maybe the annual holiday gets cut short. All things that I would not like to see anybody in our team doing or having to do, especially with rising interest rates. The average $500,000 loan has gone up $12,000 per year, $1,000 per month. Now, you just imagine you've got 2, 3 negative geared properties. Not the way to go. Make sure that your portfolio is paying for itself completely with all costs. And by the way, at 100% calculatory. Yeah, I think, Andrew, you've got your microphone on. Can I ask you to mute yourself, please? Yeah, so look for a balanced portfolio. I talked about financing, the bank's calculators. You'll run out of steam very, very quickly. It is the small money. Now, $50 a month in income from a positive geared property is not bad. But you compare that, and what is that, $600 a year? Heck, make it $1,000 a month. That's $12,000 a year. And there'll be very few properties that will yield $250 in positive cash flow per week. But, per month. But per week. So that's $12,000 a year. But take a normal property, let's call it $500,000. If you get a capital gain of an increase in value of 10%, that's $50,000. That's why this small money is the rental income. But you cannot get to the big money. You cannot sit there and wait if you don't have the small money. That's the point. It is risk mitigation. And that is part of a multiple property strategy. All right. When I talk about rental, I talk about my good friend, David Forrest. Over to you.
Thanks, Uwe. As I said, it's good to be here again and talking with you about this very important subject. I want to cover a couple of aspects today or tonight. Firstly, your relationship with your property manager and how to choose your property manager. It's an important aspect of property investment. And secondly, I want to talk about maximising your rent. And I know that might sound incredibly basic, but it's amazing how often we find when we take over properties that have been managed for some years, they're just not actually maximised. The first aspect is the property management and landlord relationship and choosing a property manager. And there's been lots written, and certainly on both of these subjects, you'll find blogs on our website that I've written about both subjects so that you can go into it in more detail. Probably the first thing that I would look at when I'm trying to choose a property manager, and I've certainly done this in the past, is choose a property manager that's got a track record. Quite often you see startup real estate agents advertising themselves as boutique and those sort of things. And boutique's really just another word for I've just started and I'm trying to get bigger. The point is you need to have an agency that's got a track record and a structural capacity to manage your property through holidays and sicknesses and all those sort of things. So have a look at the history of the organisation that you're dealing with. It's actually more important than the individual. The other aspect that I'd suggest that you have a really close look at is where does property management fit in the structure of the organisation that you're actually thinking of employing? Is it little brother? In other words, is it the side gig for a sales department? My way of thinking is if you're a professional investor, then you want people that are professional property managers and that is the major aspect of their business. So I'd have a close look at that if I was you. The other one that I'd have a look at is, and it'll give you an indication of whether it is a property management centric organisation, is who is in charge. When you're talking to somebody about joining or asking them to do the management of your property, who are you talking to? You're talking to the principal? Is the principal involved? Is it the general manager? Or is it just someone that's on a commission to bring in as many properties as possible? You want to know whether senior management is actively involved in the property management department of the business that you're thinking of joining. And secondly, not finally, but heading that way, make sure that you have a relationship with your property manager and your property management organisation, that you don't just hand over the job to your property manager. Professional and good landlords are landlords that are involved in the process. Don't just want to buy the property and then wash their hands of it and don't want to hear about it until I get the annual financial statement. That's not really the way to go. I'd suggest that you had a real conversation with your property manager and property management company at the very beginning to examine and discuss what it is that you exactly want out of the relationship. Do you want to be told whether there's a $50 maintenance issue every time one pops up? What level of interest do you want? 50, 200, a week's rent, 2 weeks rent? Get these sort of parameters clear so that the relationship can start building rather than being a pestering relationship where you can actually delegate to your property manager, but at the same time be involved. The second subject, and I'm happy to answer any questions about that in the future, or if you'd like, have a read of my blogs. The second aspect that I'd like to talk to you about is maximising your rent. Again, have a conversation with your property manager. Make sure your rent, your current rent that you're getting for your property, matches the market. Now, I know you're going to go, well, of course. Well, I can tell you, so many properties that come into our organisation are under rent. And worse still, I get landlords that say, when we advise them it's time to increase the rent, the market's moved further forward. Oh, look, they're really good tenants. I don't want to upset them. Let's sort of leave it as it is. All you're going to do is exacerbate a problem with those tenants in 2-3 years' time when you've done that for a while and you suddenly feel like you need to catch up to the market. and then all of a sudden there's this monumental increase that your tenants are facing. Whereas if you've done it step by step over those 2 to 3 years, you're not going to hurt your tenant. And at the end of the day, the idea is that you have an investment, and as Uwe said, you've got to look after the little money, and that little money is important. So keep abreast of the market, and when your leases finish, make sure your property manager is doing a current market analysis so that you can actually see what sort of rent you should be getting for the property and make sure you get it. And trust me, tenants know what they should be paying. They're as aware as we are. Other ways to sort of maximise your rent is with some of your expenses. If you've got a strata title unit, many of the strata title management companies will give you a discount if you pay on time or within a certain amount of time or early. Look closely at the opportunity to do that. Water. Water is another aspect that we really think that needs to be sort of examined. How much water, if any, can you actually charge your tenant? Solar power is another thing. Make sure that you know who's getting the rebate and how that remains and who that remains with. Tax depreciation. Make sure that you actually get a surveyor. We've been using one particular group, BMT, for years, and I can't tell you how many people have been saying thank you to us with the amount of money that they've saved, because that maximises your after-tax situation. And the last thing that I want to talk about when we're talking about maximising your rents and your relationship with your property manager is be maintenance proactive. Don't just fix things when they go wrong. Be fully aware and have a close relationship with your property manager to search for things that need updating, that need looking after. We've so many times sort of told landlords over the years that this needs to be done and that needs to be done and you should do that. And then they turn around and say, okay, let's sell the property. And you say, well, okay, let's get this done. Total costs about 10 grand. You're kidding me? No, you should have actually got these things done and you wouldn't be up for this sort of expense. And mostly proactive maintenance is cheaper than repair. So be aware of your maintenance and maintain the property at its absolute peak. But if for no other reason than if you suddenly want to sell, it's ready to go. And I think that's probably about as much as I want to sort of spend time on tonight. I don't want to bore you. Certainly available for any questions or if anyone wants to email me. And I'll hand it back to Uwe.
All right. Thanks very much, David. Some really good points there. And you can tell the vast amount of experience that David has. And there is a reason why we're using his business under his guidance for our rental property management. All right. I want to cover the other side of the coin, and that is capital growth. One of the most misunderstood and badgered around subjects and topics. First of all, we talked about the rental income being the short-term money. Well, the capital growth is the long-term money. That's really the nirvana. That's what we're all chasing because that's where the big bucks are. We've all heard the story about the property that doubled in 2, 3, 4 years. Are they out there? Can that happen? Yes. But I defy anybody that can promise me that this will happen. There is no exact science in that. So what we want to do is look for steady growth, and dare I say it again, with enough rental income to boot. The long-term money is the big money. And from a strategy point of view, there are different phases. I talk about that in a minute. In the property accumulation, in the property consolidation, and in the repatriation phase. The long-term money, the capital gains, will give you the lifestyle. It will be able to allow you to retire debt, and have unencumbered properties that you can live off very nicely. Thank you very much. And if you're so inclined, if you maintain your properties well, as David was saying, they keep their value, they keep their peak rental performance and can provide a legacy. So refinancing, look at it. When is the property cycle at its peak in the area where you're investing? That is the time to refinance, even if you just have the money sitting in an offset account. There is no cheaper, what I call insurance policy, than having refinanced. Say you took $100,000 extra on, stick it in a redraw account, in an offset account, more to the point. It will not cost you any money, because as long as you don't draw the money, you're not paying any interest. But you tell me, I argue the point that there are very few things in life that you can't fix with $100,000, and you can write a check like that. That's the cheapest insurance policy that I can think of, because it's going to cost you nothing. A bit of work, a bit of effort, but you've got the cash money sitting there. No flexibility is as big as that. And of course, the capital gains is the big money. I talked about it. 10% on a $500,000 property is $50,000. Many people work a year for that. So why do we need both? That's the big question. Well, it's all about the roadmap. It's all about the planning. It's all about the balance. Everybody talks about balance. But if you don't have the rental income high enough, as we discussed, you run out of steam. If you don't have the growth and you only have a small additional yield in rental income, you're not going to be able to withdraw equity and jump into the next property. So that's what the roadmap is all about. A good property strategist, a good property investor has, let's call it in business terms, a business plan. What's my roadmap? Where do I want to be in 5, in 10, in 15 years? My strategy changes dramatically depending on what I put more value, more emphasis on. So that's why the initial discovery session is so important. There is no one size fits all. We are all individuals. We all want to do different things. And that's why a property strategy, why the roadmap needs to be individually developed. I alluded to 3 phases: the capital accumulation phase, the property accumulation phase, the first phase, where the person that accumulates the most amount of properties in the shortest amount of time at balance, hear me, will win. Why do I say that? It is the growing up phase. It is the phase where everything sprouts, where we want to expand the portfolio. Then we get to, the consolidation phase, where we, through a balanced portfolio, have time look after the big money, the capital growth. Think about it. If my portfolio doesn't cost me a dime to take out of my after-tax money, if my portfolio runs itself on a cost basis, then really my risk of, let's go back to Sydney, 7 years no capital growth, is mitigated because it doesn't eat me out of house and home. I can just sit there and wait for the capital growth to come. And it will come. It inevitably does. Invariably comes. There is a property cycle. But there's just about nobody that can accurately determine and forecast what that cycle is. Yes, there is indicators. And we play with that as well. But ultimately, if I have a balanced portfolio, if I don't need to fork out cash, I can just sit there and wait for the big money to come. And then we get to the repatriation phase when you have got a number of properties that have got good equity in them. You can take the capital gains out, repatriate it, and pay properties out so that they are unencumbered, paying you $25,000, $30,000 a year. Now, here comes the reason for the minimum of 3. If I have 3 properties at $30,000 unencumbered, pay a little bit of tax, and that depends on structuring, and we can talk about that as well, then I would suggest at $90,000 gross income per year, that would make a serious difference to about 95% of people in Australia. That would certainly allow you options. It would certainly give you choices in retirement. Because I don't know about you, but I don't want to live off $24,000 pension. That ain't much fun. So, feed the golden goose that lays the golden eggs. 3 phases. All right, let's look at a case study. The property that you see in this beautiful photo with some water views is in Tasmania. Purchased in 2018, house and land, $360,000. Them were the good times. We picked it well. Anticipated rent was $390 a week, a rental yield of 5.6%. Notice that the rental yield is fairly high. That's the only way to make a property pay for itself completely. Now, that property in 5 years did double in value. Yes, we picked it well. Do we do that all the time? No, sometimes you have to wait. And the rental now sits at $560 a week. I'll leave you to work out what the yield is. Very good. And the investor was very clever. At about $520,000 worth of value, they refinanced and have the money sitting in an offset account. That's the way to do it. Not only can they live with the security in their mind that they can access cash funds whenever they want, but they can also pounce on opportunities. So today, I said it, the values are there. Now, let's talk about a hotspot. I'm in Cairns. Here's a design of a property that we are building as we speak. The vacancy rate is 0.5% in that area. Balance is generally described as 3.5 to 4.5%. So tight as a drum, absolutely in favor of the landlord. The contract price for that, including everything, turnkey, including window furnishings, everything is $593. Now, it will provide great cash flow and equity. Why do I say that? Because I know that the purchase price for the block of land already has got $20,000 worth of capital growth in it. I know that because of the wholesale buying power that we can muster up, there is a difference between wholesale and retail, and that's additional equity, additional capital gain. That is manufactured, that is built in from day one into the deal. That is strategy. That is specific intent. Last quarter, that area has gone up 10.6%. And we're talking an area of Cairns. See, if you go by strategy, you go where the strategy works. And I don't need to have it working next to where I live. I don't need to check on the loans myself. I've got guys like David for that, who are professionals in what they do. So we go wherever the formula works. And the stock on the market was 73. It's a 10-year low. The weekly rent, the median rent, was 550 and went up 11.3% in the quarter. This is incredible figures that are absolutely achievable. There's infrastructure, new shopping center, the highway is being duplicated, probably a year off, 3/4 of a year of being finished. Big retirement center. There's a McDonald's, there's a Subway, there's a big new IGI, strip shops. This is all indicators that you can look at that make an area move. And after all the theoretical data, do your local research and verification. Get somebody to have a look at it. So, with whom? Allow me to indulge myself. Property Friends. We've been in business for 20 years. 76% of our business is returning clients. Something is working here. We're doing something right. Our 7-step success system provides accurate, unbiased investment guidance, training and opportunity, and we mitigate risk. We have regular sessions where we provide knowledge and pass knowledge on. I enjoy passing knowledge on because if we grow, we individually and cumulative can do more. We've got some people on the call that have seen that. Full disclosure, we get paid by you. And I want that separation. I reckon it's a hell of a conflict of interest if I get paid by the builder or by the developers. Because ultimately, again, the old knowledge applies. We serve who pays us. So we get paid by you, the client, and that's a separation of interest that I think needs to be done. You can check out our client feedback and testimonials. Actually, I've got one here. Allow me to play it.
G'day, I'm Dion and this is my wife Jacinta. We've just recently completed our very first home with Property Friends. That house is in Townsville. We've gone and inspected it and seen everything that's come together over the period of time during the build. We're very, very happy. With all the advice that we've been able to get through Property Friends, we've certainly had the encouragement and the confidence to pursue our investment path and tackle another one, which will be in another state, which will be ready very soon. Through Property Friends, we've been able to access information, advice sharing, and a whole network of people that's been invaluable to the confidence that we need to get our property portfolio started. Thanks.
Yeah, look, I have to admit, I'm very proud of this. Dion and Jacinta have gone on to bigger and better things. They've got a very nice and substantial portfolio now. So certainly for a young family with now 3 children, a magnificent start, and they're doing great things. All right, the why. It has to be all about you. Get the information, do your own due diligence. I come back to the question, where are you at? What's the end goal? Where do we want to end up? Where are we going? And then, and only then, can we develop a customized multi-property strategy. As I said, I offer a discovery call, and I'm certain, and David has said so as well. Check up on his blogs and talk to his team, talk to David. There's certainly great information out there, and take advantage of it. All right, we've come to the fun part, the Q&A. I've seen a couple of questions online. One of the questions was, David, you might want to join me. One of the questions was, I'm harping on balance between growth and yield. Yes, I am. Can I ask you, have you seen guys that have had big negative year properties and And we haven't rehearsed this,
No,
so I'm putting you on the spot.
thanks.
What's your thoughts on that?
Absolutely. We often see people that have sort of fallen for the negative gearing spruik, if you want to put it that way. Look, sometime in certain circumstances, negative gearing does make a bit of sense. But what we're seeing more often than not is people saying to us, well, I can't get that maintenance done because I've got no money.
Mm.
And they've got no money because they're negatively geared. If they had money that was surplus and they'd done their budgets and that sort of thing, then you'd probably find there's not an issue with what I call proactive maintenance. And I certainly do see it. And it's more prevalent, definitely, with people that are negatively geared.
What I have the big problem with is taxation benefits can only be, in my world, an added benefit. Allow me to say it this way. If you go into property investment for taxation benefits with a negative gear to have a good tax deduction, I make you a special offer, a very special offer. You give me $100, I give you $35 taxation benefit back. Let me repeat that. You give me $100, I give you $35 back. When I say it like that, it ain't such a good deal, is it? So that's why I'm harping on balance between income and yield. And you get stopped dead in your tracks if you don't have enough rental income. You cannot do the maintenance, it eats you out of house and home, your lifestyle suffers. Not the way to go. Oh, there's another. Oh, this one is for you, David. How do I make sure that I get the optimum rental income?
That's a good question, and there's a twofold answer to that. Firstly, if you're going to be an investor and a good investor, then you should keep a track of the market in your area as well. Things like looking at what people are advertising just on realestate.com. You know, what rents are being advertised in the suburb that you're invested in. You know, have a look at the photographs of the house and see that, you know, does that house or that unit or that apartment look the same as mine? Does it have the same features? Has it got a pool or doesn't it have a pool? Compare it and try and make it a good assessment yourself. Educate yourself, okay? Then ask your real estate agent to give you their opinion. Now, hopefully those two opinions should be absolutely identical. But if they're not, then there needs to be a discussion. And why is there a difference? And that is really the best way to make sure that you are optimizing or you're keeping a track of what the market around your unit or your investment is. Does that make sense?
Absolutely. Absolutely. Yeah, look, might just quickly make a special offer for the people on the call. There's a resource that we have put together, a book that I've written over 5 years, actually. 7 Secrets of Highly Successful Property Investors. As a PDF version, hop on our website, propertyfriends.com.au, and you can download it for $10 with the code ebook for success. As if we want to book a strategy call, propertyfriends.com. propertyfriends.youcanbookme. Hang on, I'll do that again. propertyfriends.youcanbookme. youcanbook.me. You get it. It's on every page at the bottom of our webpage. Look, I hope that has given you a bit of an overview. We didn't want to make it a big song and dance act. There was lots of good information available. If you have any further questions, I'm sure David and I are happy to answer questions on email as well if you come to something later. And let's just have a chat. That's the big message.
Yeah.
Do you think so?
Give me a call, email me, don't mind.
Yeah.
Happy to help.
It's been a great pleasure. Thank you, David.
Thank you.
Excellent. Thank you for being here. Have a good one. Bye-bye.